Okay. All right. So, welcome to this training or webinar, and I'll be discussing within the next couple of minutes how you can earn $1,000 to $5,000 monthly from the financial markets. And there's going to be a case study as we progress. All right. And of course, the theme I'm looking at is how you can become a full-time trader without blowing up another trading account. And the way you're going to achieve that is by using the market structure and liquidity only. It's like Forex 101, yet very, very powerful. And this is the goal, or this is my goal for this training. Now, let me ethically bribe you. By the end of this training, you are going to learn how to win as a trader. And I have gifts for 5 persons at the end of the video. Now, it's obvious that you are streaming this on a personal PC or what have you. So if you are able to stay to the end, I will definitely have a bribe for you should you be able to meet up or qualified. All right. So what makes this training different, all right, from every other trading classes you have attended before now? It's that it is practical, period. It is practical. All right. So just a little bit about me just before we continue. I am Jay Okoli. I'm a full-time trader. I've been trading since 2019 and a multi-six-figure prop firm trader with Funded Nest and my forest factory. Of course, successfully trained over 2,500 Africans since 2020 and still counting. Of course, got married in 2021. Pretty young. Of course, I'm pretty young and I'm living my best life. I mean, it's beautiful. It's beautiful. Of course, I'm an author and a coach, and soon going to be working with you. All right. So as we progress, I'm going to be sharing a little things about not just myself, but from my community, and so you can actually know that what you are learning is not a fluke. This will actually be the game changer for you. I have done a whole lot of things right lately, especially since I started having profitability consistently from the financial markets. I've also done or did a lot of things wrongly in the past. Okay, and I'm going to give you a tip of one or two of what I did wrong in the past. Now, after my first 4 trading accounts was blown, I discovered the following. Right now, when I blew my first several of my earlier accounts, these were the things I discovered, especially on my route to becoming profitable. First thing I discovered was that trading is rigged and manipulated against the retail or ill-informed trader. Of course, we are all retail trader, but the emphasis is the ill-informed trader. Okay, so it seems the people that wants to make the bucks from the market, they are the ones that ends up not making anything, while the ones who seem to be profitable are not seemingly doing anything extra, but they know something. So there is a knowledge gap that a lot of persons who are not profitable, probably are in that category, that needs to be bridged. I discovered that. I also discovered that you do not need a 70% win rate strategy. So you do not need your strategy to have a 70% strike rate for you to stay profitable. As a matter of fact, we have a video in our YouTube channel where I did talk about the 30% rule. All right, but I discovered this along the line. I also discovered that trading is more of the mind than your strategy. Again, psychology. There is something that you need to know. There is a state of mind you need to have for you to be consistently profitable. So bigger than strategy. And a lot of traders, we are all about strategy. We want to know what's the next big thing. And then we are all about the next big thing, only to find out that it doesn't end up leaving us profitable. So we end up having fat knowledge and very lean bank account balances. Increased knowledge, yet not reciprocating in our profits and our portfolio. And that is a problem. And there's something that was something I discovered along the line. And of course, I'm going to discuss more of these as we progress, but I just don't want this whole thing to be so long or very lengthy. Now, of course, I discovered these the hard way, and the hard way was terrible. right? And one of the things that I did in my earlier years, just like I was mentioning about multiple strategy, was I was trading with multiple indicators. I was using moving averages, Bollinger Bands, so many, and you can see that picture by the right of my screen. It was from one level of frustration to another. It was a vicious cycle. And one of the worst experience I had was to use a trading bot. Trading bots, to say the least, are terrible. I mean, if you have one that is working for you, not mean to disrespect your strategy or what it's working for, you may actually stop the video and go continue using it. But if you are still here, probably you have had an experience with a trading bot, right? So I had a trading bot negative experience earlier in my trading career, and that's actually led to the first 3 accounts that I blew. After my first one was manual, the other 3 was trading bot. It was terrible, right? And of course, I accumulated lots of mentors, like most of you most have probably have lots of mentors. I got lots of courses till I got disorganized. So I had what I call, or what traders call, analysis paralysis. All right, and this is a very terrible state you do not want to be in. So when you look at the market, like 5 things pops up in your mind with respect to what you want to do at any given time. It's a very terrible place to be, especially when you are not profitable, right? So in the past 4 years, I mean prior to 2019, I have been, or had been, to the trenches and back, and I wish to share my journey experience with you, especially within the confine of what we are studying, to see how this can help you win as well. Now, results are not typical, so this is a disclaimer, quick disclaimer. But you can see my screen, right? I am not a huge fan of sharing lifestyles, right? Because I know that that's what people see a lot in the social media spaces, and it can get a bit deceptive. All right, so I'm not a huge fan of sharing results and lifestyles. However, to help you or strengthen your mind a bit, you can see a few of what I have cropped from our community, from passing a Profem account to drawing over almost 4 million naira in Nigerian currency, from our student raking in $1,000, another giving testimonial. You can see, I mean, these are just a tip of the iceberg, what you can achieve. If you watch the advert video carefully that brought you here, you definitely saw how we took these trades, not before and after, but I gave you and that's what we're going to be doing right here. All right, so results are not typical. You are going to actually require to put in the work to get results like this, but the work will actually start from the right knowledge. All right, so in this class I'll be discussing 3 secrets, not really secret per se, but I will streamline my sessions into 3 of how you can become a full-time trader. Because the truth of the matter is that you cannot become a full-time trader when you put a part-time job to trading. You cannot get a full-time trader's reward if your attitude to trading is part-time. All right, so I'm putting this in 3 phases. The first is how to get a proper psychology as a trader. There is a way your mind should work for you to be successful as a trader. The second one, I'll be talking about the market structure, right? Where you can buy and sell appropriately. So I'm discussing the market structure, and not entirely different from what you know, but I'll bring in a twist into that, something that will actually skyrocket or improve your results. Then finally, I'll be talking about your entry, which, by the way, we know that entry is everything. I'll be talking about your entries, and I'll be bringing in a liquidity entry model, right? Because of the sniper approach it has to the market, the tight stop loss, and the insanely huge risk to reward ratio. All right, so let's just proceed, and I believe you are ready to learn. So first things first, please get a writing material, get distractions out of your way, and be ready to learn. So let's talk about psychology for just a couple of minutes. Now, trading works in a way, I'm going to give you my story. Trading works in a way that it is designed to, like the way wealth is, not wealth is attracted to those who follows the process. By following the process, patience is one of them, and you must be sure to be doing the right thing. Just a number of time, wealth comes to those who build, right? Now, you cannot be digging the wrong hole and expect to somehow bust or strike the gold mine. I'll say that again. For the fact you are spend long enough time in the wrong path will not automatically make it right. So you want to be sure that what you are spending time on is the right thing. right? Now, the psychology part of trading, the first things first, from my story, when I started trading in 2016, I got a $500 free trading account from my forest fund. Then it was not a problem, it was just a new firm at the time, and they were doing $500 startup for people. So I traded the account. By the next day, I had $50 profit. That's about 10%. I recall I wanted to withdraw. I couldn't withdraw. They asked me to deposit 10%. They asked me to deposit 10% of the entire balance for me to withdraw, and then they said I should trade like 3 lots. So back and forth, I was a bit confused. Why would they not allow me to withdraw? But the fascinating thing then to me was I just clicked a piece of mouse. I just clicked my mouse to buy Euro USD, and by the following day I was up $50. How that happened, I don't know, and that got me fascinated. Then I knew that there is a future in trading, but I over leveraged because I couldn't get that withdrawal because of the terms. I tried to trade more to 3 lots. I ended up blowing that account. So that was the first lesson I began or started to learn, that your risk management is the holy grail of trading. And you must understand that the moment you click your buy or sell as a trader, you don't have anything to do with the market going forward. It's not your fault that the market will hit your stop loss or hit your take profit. You are only hoping that it's going to go for your take profit, but you should expect stop loss to be hit. In fact, take this from me, the best and successful traders are actually what we call good losers. You must be able to know how to lose very well. All right. And one of the ways that works for you to eventually be your advantage is when you are not over leveraging. You are not trading more than 1% of your account size at any given time. If you are risking 1% of your account at every time you are trading, it will take you 100 trades to end up blowing up your account. 100 consistently wrong trades. Are you seeing that? Now, if that eventually happens, that means your strategy is totally whacked up. Okay? But because we are humans, there is that greed factor, fear and greed, that you need to conquer. In fact, you are not in the business to compete with anybody, but to actually conquer yourself. Conquering yourself is more difficult than I am sounding, because you have to deal with that fear factor because of losses. You have to deal with that greed factor because you want to get it right immediately. Maybe probably just coming back from a loss. Now, after this class, I'll return back to this conversation from my story and all of that, because if you do not appreciate this fact, everything you're going to be learning will either rise together or fall apart if your strategy, if your psychology regarding risk management is not tight. So from my story, eventually I blew that account, got several accounts on demo. I was doing very well. Went to live accounts. Okay, I blew like my live account. The other time I used bots, I blew all of those. But all of the common denominator across all of these things, and you can tell that for free, is that at every time I end up blowing my account, is as a result of me over leveraging. Okay, that's one. Then two, not maintaining a healthy risk to reward ratio. So I wrote down something in my next slide here. I said this is a summary of what I want to know about psychology, so we can move into the all that technical part of the trade. Right? You have to understand that your only edge as a trader is risk management. Do not allow anybody fool you. Now, let me ask you a question. If you have traded for a while, you will attest that the time you feel the most pressure is when you know that you are actually in a mess as regarding risk management. So you will be in a relatively more point of ease when you know that if the trade hits your stop loss, you are just going to lose $1 from $1,000 account. You are going to be in a more relative ease if you know just $1 will go from $1,000 account than you would when you know that $100 will be lost if you from $1,000 account if your stop loss is hit. I don't know if you understand that. So the ease, the pressure, and when you have that ease in your trading, it makes us do irrational stuff. You cut your losses too quick, you take profit too quick because you are not certain and you don't want to be in that mess. You don't want to be there. Another thing you want to put into consideration is that you must learn to journal your trades. You must learn to have journals. You must learn to document your trades so you can return back to those at the end of the week, at the end of the month, or whatever, so that you can actually measure your progress. If you make a mistake twice or thrice, that means you are not learning. And a lot of traders, a whole lot of traders do not document, do not journal, do not even go back to their trade. So if you're listening to me right now, you fall in that category. One of the things you want to take home, first of all, get a trading journal. It doesn't have to be a physical book. There are softwares like Notion. I think in our mentorship we do provide some of this stuff, but then you can get them for free and start recording your trades, recording your before and after. At the end of the week or the end of the month, go back and study, so you will not repeatedly be doing the same thing over. You see, the definition of insanity is doing the same thing over and over again and expect a different result. And of course, the third thing I found that, and this particular one completely revolutionized my career, it was when I started trading fewer pairs. When I started trading, I could trade anything that moves. I'm trading Nasdaq, I'm trading CAT CHF, I'm trading South African Rand, USD, all manner, USD ZAR, all manner. You see, but when I streamlined to becoming a specialist, Euro, dollar, pound, dollar, then gold, right? The whole thing of the pressure eased away, fizzled out. And then, in as much as I'm trading fewer pairs, I'm also reducing or trading at fewer frequencies. So trade fewer pairs and trade at fewer times. It's going to help you a whole lot. And of course, finally on this, before we move on, you want to have a trading body or a community to help you grow faster. Someone to rub mind with the same vision, right? It's going to help you to grow faster. Now, this meeting or this webinar is not about my story, but I'm sharing from my personal life and experiences with hopes that's going to help you to succeed as well. All right. Now, let's move into the number 2, which is market structure. And I will introduce in FVG, and then I'll talk about liquidity, and then I will switch to 3. So I will do 2 and 3 concurrently. All right. So let's look at market structure. Of course, we all know what market structure is. This is Forex 101. Market structure is in 3 phases. You can have your market in 3 phases: uptrend, downtrend, consolidation. So for in this class, we are concerned with the trending market, uptrend or downtrend. So in my far left, you can see your typical uptrend to a downtrend. So this is more or less like a market cycle, right? So for the uptrend, you have higher high, higher low, higher high, higher low, like that. For the downtrend, you have your lower high, lower low, lower high, lower low, lower high, and this is typical of your market structure. All right. Now, please, I want you to pay special attention to what happens during or before a change of trend. First of all, look at this area where the trend changed from uptrend to downtrend. So I cropped that area into this point. So you see what price did here? Went up, right? Formed a higher high with respect to the previous high, then another higher high, and then price broke aggressively to the downside, took out the lower high right there. So you see this character where price sweeps as it were liquidity to the upside in that high, taking out this high, taken out by that movement, and the price comes down, takes out the low, not just any high or low. It must be important high and an important low. We'll look at that more when we start looking at our charts, right? Now, this is a change of trend from the bull to a bear, from a bullish market to a bearish market. The opposite here, from a bearish market to a bullish market. So what did we see? Price created a low, broke the low. So you see a break of market structure. A very important low was broken. And then price rallied up, took out a very important high. So this is a trend change from a bear market to a bull market. So this is just something, it's regular, it's all over the chart. You just have to take note of these as we proceed. Now, let's now discuss EPD, right? And first of all, let's talk about a swing, analogy of a swing. So in an uptrend, for example, where this movement starts, we know that this uptrend gets validated the moment there is a break of market structure. To that left, you can see my cursor right there. So the uptrend gets validated as price rallies up to break market structure. that means our uptrend continues. Then it goes all the way to the high, then it pulls back, right? A substructure or a pullback. Now the uptrend continues only after the next high is taken out. So price halfway to that high hasn't confirmed anything yet, right? So but once it breaks it like the way it did right there, you can say the uptrend is showing willingness to continue. So expect another pullback and then continue, just like we saw in the typical market structure. The same thing for a downtrend. Price pulls back, it distributes downwards, right? Pulls back, right? The first drop took out this low right there, right? And then pulled back, rallied lower right here, and broke the structure right there. All right. Now this is so important to take note of, that until the structure is broken, there are no guarantees that your trend is continually being an uptrend or a downtrend. This is Forex 101, so it's not a difficult concept. Now let's look at EPD. EPD simply means equilibrium, premium, and discount. Equilibrium, premium, and discount, and it's a very simple concept. Now, for an uptrend or for any trend, either uptrend or a downtrend, that swing that leads to the break of market structure, like in this uptrend, that swing or this swing, or this swing. For a downtrend, this first leg or this second leg, right? Now the midpoint of every or any swing is the 50% level, which we refer to as an equilibrium level. So equilibrium simply means the 50% of a level. And how do you get equilibrium? Use your Fibonacci tool, extend it from low to high, mark out your 50%. That is your equilibrium. Equilibrium is your place where price will most likely rest. So it's a resting point for price, right? Now below the equilibrium or below 50% of any price range is what you refer to as your discount. Discount is the level of below your equilibrium. Below 50% is your discount, and your discount is where you only look to buy. Your discount is your buy zone, right? Your discount is your buy zone. Above your equilibrium is what we refer to as your premium zone, and your premium is actually also called your sell zone, where you look to sell if you are bearish. So let me put this in context. If you are in a bullish market, you don't just buy anywhere to join the bullish trend. You want to see price come down to your discount or below equilibrium. If you are bearish, you want to see price pull back to your premium area before you look to sell. This is so important because, and usually before price gets to your discount zone in a bull market, it will do several stuffs at the top to make you want to buy, and those are fake outs. You want to wait for price to enter your discount zone before you look for your next buy. So in this case, you see price pulled back to equilibrium, slightly into discount, and you are safe to start buying there into that range. You see this example, price moved, it's in a bearish market. After dropping, you have to wait for price to pull back to this premium area just above your 50% level, and then you look to sell around that area. Hope that's very clear. It's very simple to take note of, right? So let's discuss market inefficiency. Now the reason we are doing all of this before we look at charts is so when we get to our live charts, you will see the whole thing comes together. All right, it comes together when we get to our chart. So market inefficiency. So before you talk about market inefficiency, you must know what market efficiency is. Market efficiency is that balance that happens between candlesticks or price action in the market. So take these examples I drew right here as candle 1, candle 2, candle 3. Now note that the low of candle 1 and the high of candle 3, if I draw a straight line across, there is an interaction. Now once this thing happens, it tells me that candle 1, 2, 3, there is a market efficiency there, because the low of candle 1 and the high of candle 3, they interact when you draw the line through the body of candle 2, right? So of course we know that where candle 1 close is where candle 2 will open. where candle 2 closes, where candle 3 will open, right? However, I'm concerned with candle 1 and 3 for market efficiency, so that the high of candle 3 and low of candle 1 should interact. Alternatively, or the opposite direction I should say, where you have the low of candle 1 and the high of candle 3, when you draw a line in this example, does not overlap like you have in this first case scenario. That presents what we call, or what ICT calls, fair value gap, right? So you see there is a space between the low of candle 1 and the high of candle 3 called a fair value gap. It's called a gap. So what price we usually do, this actually results to market inefficiency. So there is an imbalance in the marketplace when this kind of thing occurs. So the algorithm that controls price, because price does not move randomly, and you're going to see this as we move to the next and final session, right? The algorithm that controls price will see this inefficiency and try to go and fill it. So this line connotes candlesticks, several candles that would rally up all the way to come and fill that inefficiency. And when the price is still bearish, once it fills it up, it will now continue going lower. Of course, I can do for a bullish scenario. So let's assume this is a bullish scenario. Price will come back, fill it, and then continue going higher. So every inefficiencies or fair value gap will be filled. It's a matter of time. Every fair value gaps or market inefficiency will be filled or made efficient, just a matter of time, right? So even on this, you can already have a trade idea, and I do this a whole lot of time. Once you spot fair value gaps in the higher time frames, like weekly, monthly, daily, whatever time frame, and you see price showing a willingness to return to that fair value gap, right, you can actually start looking for buys till that fair value gap, and you're going to learn more about that as we proceed. Now let's talk about liquidity. Now this is secret number 3. Like I said, so I was going to merge 2 and 3 together. Let's talk about liquidity and entry, because this is essentially everything put together is why we are here. And listen, if you have followed to this point, this will completely change the way you look at the market. Right now, first things first, liquidity is the fuel of the market. And like my mentor would say, if you cannot spot out a liquidity or where liquidity are resting in the market, please take it from me that you have become the liquidity that will be taken out next. So liquidity is the fuel to the market, as your gasoline is to your, or as your gas is to your automobile, right? So without liquidity, there will be no movement in the market. And you're going to see from price action, as we're going to look in the next couple of minutes, how that once liquidity is taken out, or until liquidity gets taken out, price does not seem to have momentum to do anything. Or alternatively, every time you see momentum in the price in the marketplace, is because price is going to take out a liquidity or is going to fill out an inefficiency. All right. Now, liquidities are usually psychological areas where traders put their orders. By orders, we mean stop loss, take profits, buy stops, sell stops, buy limits, sell limits. So liquidities are psychological areas. Okay, don't let that confuse you. So when you place a trade, where do you always hope to put your stop loss? If you are selling, your stop loss will go behind a swing high. If you are buying, your stop loss will go below a swing low, or of course below your entries. Can be below a swing low, can be below or above equal tops and bottoms, etc. So wherever your orders are going to be placed, buy stop, sell stop, buy limit, sell limit, buy, sells, take profit, stop loss. These areas, all of them are areas of liquidity. So liquidity is all over the market space. They are above swing highs. I just mentioned that they are above the highs and lows of previous days, previous weeks, previous month, above or below equal highs, that is equal tops, equal bottoms, etc. They are everywhere, right? Now, one thing about liquidity and its entry is that it gives trading one of the best or finest entry. Plus, you have a tight stop loss and an insanely huge risk to reward ratio. Okay, so for this class, I'm going to explain liquidity and our entry models in 2 scenarios. Obviously, there are more, but let's focus on 2 and see how far we can go from there. I hope you're learning really good so far. Now, this is scenario 1, and I want you to screenshot this. I'm going to explain this for a moment. Now, scenario 1 works this way. The first example by my left shows in a bullish market scenario. So what price does, remember we say liquidity rests above and below hold highs and lows, swing highs, swing lows. So ideally, price rallied up this way, right? And BOS means break of structure. So price rallied up this way, broke market structure right there, right? Now, this scenario works in a way that because price did this movement to break our market structure, and it was a straightforward movement, a very clean movement to the upside, the algorithm that controls price sees that this is a very clean movement and price wants to continue going higher because we are bullish. So what price will do is that it will come back, right? It will fall down back and take out the low that started this movement. It will come back lower, take out the low that started the movement, and then rally higher. I'll say that again. So in this scenario, price is bullish. That's the first thing to know. This one I'm showing is a bullish market. So price expanded to break market structure, but this expansion was so clean so that it left no internal structure. You're going to know about internal structure in the next scenario. It's so clean. So what will price do? It wants to keep going higher. So it has to take out liquidity for it to have the impetus or the drive. No, liquidity is the fuel. So it needs fuel to continue going higher. So what will price do? It will simply come back down and take out the starting liquidity, take it lower, right? Just take it out and boom, continues going higher. In a sell scenario, the same thing happens. Price is bearish. So it's expanded lower, broke market structure, but this expansion is too clean and price needs fuel to continue its movement lower. So where will price get the fuel? It will rally back up to take out that liquidity at that resting above that high. Liquidity is resting above that high to take it up right there, and once it takes it that, boom, it flies, it goes lower, right? How do you trade using this scenario? Because we're looking at liquidity and entry. Like this one you see right here, the blue shows where I'm buying from, right? So once price takes out this area, I'm not waiting for any confirmation. Within the right frame of mind that I am bullish, I am buying right there. Put your stop loss a little bit below the liquidity. In this example, your take profit is at that level. Very simple. Take profit at the red zone. In this other example, if you are bearish, price has done that break of structure. As it's come to take that, you are selling right there. As price takes out that liquidity, you are selling right there. Your stop loss goes a bit above, and then your take profit is at that initial. You can easily get a 1 to 3, 1 to 4, 1 to 5, 1 to 15, or 1 to 20 risk to reward ratio using scenario 1. I love scenario 1s a whole lot. When we start looking at the chart, you will see how this plays out and how you can apply this going forward. This is scenario 2. You can screenshot this if you will, and I will explain in 3, 2, 1, go. So this is scenario 2. Scenario 2 is like scenario 1, but a little bit of more advanced. So you see price is bearish in this first example. Price is bearish, and this is a major break of market structure at the downside. Now, as price is coming to break the market structure, it have a high right there, pulled down, formed a lower high, and eventually broke the market structure. So what do you expect price to do? Price will rally back and take out that last lower high. This one, not the first one. You know, in scenario 1, we did not have any internal structure. It's just a clean movement and price comes back. In scenario 2, this is what I mean by internal structure. So price formed first leg, formed another leg internally, and then broke structure eventually. So what do you expect? Price should come back, take out that structure, take out that liquidity to have enough drive, and that is where you are selling from. The red arrow shows where you are selling from, and it goes that way. Your take profit is that leg. For a bullish market, the same thing is going to come break that market structure to the upside. But first, it rallied up, pulled back, have an internal leg, and then rally to the upside. Before price continues the bull movement, it had to come back to take out that structure, right? This is like scenario 1, right? Movement too clean, comes to take it out and goes, right? So you are buying at this level and your take profit is around that level. It can be more if you are following higher time frame narrative. Now, something I should let you also know is that for scenario 2, even for scenario 1 as well, the question you'll be asking yourself, how far into this liquidity sweep that you are buying or selling from, how far into these areas will price get to? You see there is a rectangular box at the top here and there's a rectangular box at the bottom. So how far price usually goes is determined whether or not there is a fair value gap or market inefficiency just at the top. Remember we talk about fair value gap or market inefficiency? Don't worry, I will show you with charts, right? Now, how far this will go is if there is a market inefficiency right at that level. So if there's a market inefficiency above this liquidity, price will take out the liquidity and rally into that inefficiency, fill it up, and then become bearish. So if you are putting your sell right there, if there's an inefficiency above, you should consider that in placing your stop loss. Stop loss can go above. The same thing happens if you are bullish. If you spot inefficiencies below your liquidity you expect to buy from, your stop loss can be cover that inefficiency so that price will come down this way, take liquidity, fill the inefficiency, and then you are good. Usually when you get it this way, you're going to be risking 5, 10, 15 pips max for every trade if you know what you are doing. And my aim and hopes is that after this class, you will know what you are doing. So let us see our charts so far and know how far and put all of these things we have learned together in a practical sense. So let's see a live chart, and I believe you have followed up till this point. All right. So first things first, the truth of the matter is that what you have learned so far in the past 20 plus minutes, you can actually apply in any time frame and for any pair, for forex, for binary, that is derived, for even crypto, right? Price is fractal, so you don't need to ask, Jay, you are just on one time frame. Excuse me, you're just on one time frame. What do I do in so and so time frame? No, you don't have to bother about what time frame you are looking at. Price is fractal, right? So that's important. So this is GBP USD, and this is the 15 minutes time frame. Now let's look at the first thing we talk about is market structure, right? And that's essentially very a simple concept. So this is more or less like a consolidation market, but if I would go back a bit, you can see we have a typical downtrend. Price was there, it dropped, higher high, lower high, dropped, pulled back, consolidated, dropped, pulled back, dropped. So it's a downtrend we've been having. Then when the price wants to change direction, like I told you or shared, right, when it was about to be a change in direction, what did we see? That's the structure. You see that low broken, important low, and where is the important high? The high that was formed before this last low is the important high, which is that one there. So I'm waiting for that high to be broken before you can say, okay, there is a high tendency that price wants to be bullish. And as though I'm doing a pre-recording for you, but this was a very nice trade for us in my community. So this low was taken out just as I showed you that market structure, whatever. Now that high is important. Once that high gets taken out, then there's a high probability that we are changing direction. So you see that happened right there. Price broke it, put back, and boom. So from here on, we were a bit bullish, right? We're a bit bullish. Okay, so we have that. Now, we cannot explain that this is a very good swing because notice this high right there. Once price broke all the way up there, all right, we expected that until this high is broken, the bullish trend is not, we're not guaranteed of that yet. And we talked about equilibrium, premium, and discount. So this is a given range, right? A range. I'm going to put my FIB2 from low to high. If I want to buy because I am bullish, I have seen I am bullish from these examples I gave you already. So if I want to buy or look for buys, I just got my FIB2 on the range, I am marking out my 50% level. So look at the range. Let me put a 50% level there. So this is the range from low to high. Fibonacci tool, taking it out. So if I am bullish, I will not be buying anything at the top. Buying at a premium is death trap. You don't want to buy there. You want to allow price to pull back to your discount, not equilibrium. Let me zoom in a bit so you see something else there. You want to allow price pull back to your equilibrium, right? You want to allow price pull back, and this in this example, in this very good example, this is a range low to high. This line here marks the 50% equilibrium, and below is our discount, above is premium. And if I am bullish, I want to see price come into my discount before I buy. Very simple concept. Don't let many words I'm saying confuse you. Now, that's for that. Also, we talk about fair value gap, right? Now, look at this huge candle, this body of the candle. Note the candle before it, the high of the candle before it. I am going to mark out the high. I extend it in time. That's the high of that candle. I'm going to mark out the low of the candle after it. Just extend it that way. Extend it that way. So you can see this candlestick. There is inefficiency here, or ICT calls it fair value gap. So you see price pulled back. All this pullback, apart from coming to take out below equilibrium, it had to come down inside the inefficiency to balance it. Some brokers, once price got to that low there, will open up the spread. You know that spread, bid different ask and bid price, to cover up for the, what's it called, the gap. Other times the gap does not have to be filled entirely, but that's not for today's class. Today's class is just for you to show, to reveal what we have been learning, to bring them here, right? Let me show you another gap that and because it's very important you understand this. Look at this candle right there. Okay, so I'm going to extend the gap ahead in time. Okay, and can you see the gap from this candle's high to this candle's low? There is a fair value gap right there, and this was an NFP day. I traded this beautifully on NFP. All right, because price had to return back to that gap, perfectly filled it during NFP, and boom, gave a nice 70 pips move, right? So this is me just explaining what you have learned. I've explained market structure. I have explained gaps, fair value gaps or inefficiencies, with two examples from here. You see one here, you see another one here. Let me zoom in. They are everywhere. I just want to keep this as simple as possible, right? Look at a candle. Let's zoom this one in. This is another gap. Okay, you know, at the time this was a gap, right? When this was formed, you can see that candle where you have very huge space between that candle's low, that dark candle's low, and the other high of the other dark candles. That was a space. So price rallied up immediately to rebalance. Now imagine you see this on a daily chart or on a weekly chart, so you can rest assured know that price is going to move entire day or an entire week or an entire month to go and rebalance, because price action is fractal. So that's something you should take note of. Now let's now start looking at liquidities, right? Liquidities and entries. Now we said liquidities rest above or below swing highs and lows. So below this low is liquidity. Liquidity is resting here. Above this high, there's liquidity there. Below this low, there's liquidity. Below this low, there's liquidity, right? Because people that are buying or selling or putting orders, who can put stop loss or sell stop or whatever above or below any point. So long as it's a swing point, there are liquidities resting there. And we have talked about that. So let's now look at examples of our scenarios that we mentioned. Let me give you a practical. I traded gold doing scenario 1. Okay, in fact I saw scenario 1 while we're going back, so let me go back and see if I'll pick it for you. Now, we had two scenarios, right? So what I would do when I'm recording this video, I will put the screenshot side by side so it will make more meaningful sense to you, right? Now, I can pick many examples, but let's start from, I would have just said, okay, start from scenario 2, because you can see scenario 2 two times happening. Let me show you scenario 2 here. No singular order, just shall understand what we are doing. This is a major low that price wants to come and take out. Now, on its way to taking out this low, it formed an internal structure here, there. So on its way to take out this low, it rallied down, pulled back, formed the high before doing all this thing. So that high becomes my target point for liquidity. Now we say, how far into the high will it take out? There's what we call breaker block, and you saw that during the ads. All right, breaker blocks are failed order blocks. All right, this black candle right here at the time served as an order block, but once price broke lower, it failed to become an order block. So you extend the candles in time, expecting price to pull back to it and sell off, right? So this is a breaker block entry. Now, if I don't see a breaker block, because anytime you have massive drops or massive rise, be on the lookout for breaker blocks or order blocks. In this example, there was a clean, powerful drop. The breaker block, because our reference. If you don't see breaker blocks, look out for fair value gaps, right? Like in this example, look above. Let's zoom in a bit more. Let's zoom in a bit more. Can you see a fair value gap or inefficiency there between that candle's low and this candle's high? So for correctness sake, let's put a line right there. So you see, price still kissed into that fair value gap. This was the last fair value gap, but my real entry would have been my breaker block. So where in all of this case, where would my stop loss have been? I could have safely put my stop loss right there above, because I'm considering the fair value gap, I'm considering the breaker block. But more importantly, what framed my bearish momentum is that I'm seeing a liquidity internal structure formed here. So I can actually start selling right at that level. But how far can price really play into will be as far as my breaker in this example and fair value gap. Does that make any sense? So my stop loss can be here, while I am considering price can play into this fair value gap, can play in this breaker, but my real fuel for the trade is this area. And you can see, once price fulfilled all of these things we talked about, take the liquidity, trigger the breaker, touched fair value gap right there, boom, you can see the momentum, powerful drop. This could be all you needed for a week, and then it did that stuff. Now look at, it did the same thing again. What did it do? The same thing that happened here again. Scenario 2. In fact, I love trading scenario 2s a whole lot. Now on its way to coming down, it formed a short-term high there and took out this important leg right there. Now where will be my next sell? My next sell will be price should pull back to take out that. Is it not the same thing like what we saw here? Only that this one took another day to happen. This high was formed on this day, it got triggered the following day, right? But this one happened the same day, the same US session. Look at the high. In fact, this will be my liquidity high, right? This one right there. So price rallied down, form the high before taking this. So we expect price to come back to that level. Scenario 2. Please note scenario 2. And then my take profit would be on this area. Now imagine you are selling there. How far would the price go to? How far into that liquidity will price go to? You can see there is a fair value gap or inefficiency there from that candles. Oops, brought out the wrong tool. I hope you're learning something. I'm loving this class or session already. So you see there is that area of inefficiency there, right there, from that low to this high there. So price took the liquidity and played inside, and you could be selling there. If you are selling here, your stop loss should just be above the fair value gap. Just your stop loss should cover it, and that would mean if I am selling there, oops, I cannot get my That should be around 7 pips stop loss. My take profit is at this low. This could have easily be a 1 to 4 risk to reward. You are selling there because of liquidity. Observe that stop loss there, take profit is here. Simple. Let's continue. Now, price did that for us, rallied up, was playing, consolidating. Notice this low has not been breached yet, so we are not sure if the downtrend is continuing. But then this last high becomes very important to us. Why? Because if price takes at that high, the chances are we are now becoming bullish. You see, one time frame just playing around liquidity and structure. So what is the structure telling us now? Structure tells us that a major high was taken out right there and in a bullish momentum. So what will structure mean? It means I am bullish. Now the same thing that happens here happened here, scenario 2 again. And what is it? Notice price rallied up to take out the structure, but before it did that, it created an internal structure, a low right there, right? So this low is important. All right, so if I am going to be bullish, I will not be buying at the top. I want to see price come to my discount area. How far in my discount area? Remember we talk about premium and discount. How far? In fact, come back to this example. Because I am bearish, I should expect price to pull back to my premium. So put your 52 from high to low for the entire range. Mark out your midpoint, which is that area. I just did mark out the 50%, which is equilibrium. Oops, I deleted the wrong two. This is my equilibrium, right? So because I am bearish, I expect price to come to my premium to sell. How far will price move in my premium will be the function of liquidity. So you see price pulled back into premium to that liquidity as far as the fair value gap, and then we dropped. So you see, you can't be selling at the bottom. That's why a lot of traders you get beaten out. You can't sell there. That's wrong. You must follow the pattern, the structure of liquidity. You must follow the structure of premium if you are selling. Back to the examples of our current trend. If you are bullish, and how are we bullish? Because price has taken out this important high. There, I am bullish. Now, how will I take my trade? I want to see price from the low to that high, put it out, and then bring out your fib to mark out your equilibrium area. All right. Now I want to see price come below this equilibrium before I start buying. How far into the equilibrium? Okay, because of experience, this is the liquidity I'll be considering. This low right here. Why my stop loss will be here? My stop loss obviously will be at this last low. It didn't get taken out, right? Yeah, it was safe for us to wait for price to pull back to this liquidity right there. Okay, and notice how far into liquidity it will take. How far will it go after taking liquidity? I will say that over and over again is the presence or absence of fair value. Can you see a fair value gap right there, or inefficiency? Can you see that inefficiency there? If you master these things I'm talking about, you are made. I'm telling you, you don't have to be going from daily to weekly to monthly, multiple time frame. You just have to stay 2 time frame. 1 hour 15 minutes is enough. I'm telling you, 1 hour or 15 minutes is enough. Just mastering what we are talking. I'm going to show you scenario 1, a perfect example of scenario 1. So this is again scenario 2. Price took this out. My take profit will be at that high, right? This will be your take profit area. And if you're buying off this area, stop loss is here. That's about 5p stop loss and 15p. That's 1:3 cleanly, 1 to 3. So how many examples have we seen from scenario 2? 2. So let's try and look for a scenario 1 example, right? This is a clean movement to the upside, scenario 1, and therefore we expect that the low that started the movement this way should be taken out. This is a clean movement to the upside. It got taken out right here, right? This is supposed to be a clean movement to the downside where we expect the high for scenario 1 to be taken out. The high that started that move, which in this case is that high. So we expected that high to be taken out because of it's a clean movement to the downside that took out market structure. But in this case, this is a variation of scenario 2. After it took the structure, it now formed a market structure high right there. It now formed a structure high. So the moment this high becomes formed this way, that now strengthened that other high. So every successful formation of highs will strengthen the previous one. So this high strengthened that one. All right. And so price did not have to go take that one again. It just had to come. That's why you see price just came, took out this one, got the fuel it needed, and over a couple of days it eventually fell down. Are you seeing it? This happens over and over and over and over and over again. All right. Let's see. I think I saw a close range scenario 1. Right. Okay, this was where we're coming from earlier. Now, as at the time of recording this video, I can tell you for free that this is actually my expectation. I am still heavily bearish on this pound dollar. Now, look at price just took out a major low right here. Now, this area is my swing high where I expect price to come and get its fuel from. Okay, scenario 2. So my projection is price should come take this out, and my stop loss will be very tight, just above that high, because there is no fair value gap. So I expect price to rally to take that high. I am selling with my full chest, right? My Nigerian parlance will say full chest. Stop loss is there. My take profit will be at this low that is formed. So if there's something I want you to think about right now is that, what if you know that price is going to the upside, like I am telling you right now, that price is going to take out that place and then sell off? What would that mean to you? Can't you actually buy with price to that level? Yeah. Are you thinking like I'm thinking? So I can go to 5 minutes chart, for example, and see if we can have a reason to buy, because we have known that price is rallying to that upside to buy. Okay, it's buying there to sell. So what can I see from this trade? Probably at the when market opens, you can see already there is already this is going to be like a scenario 1 example. Let's look at it. Look at scenario 1. Price just rallied up to take out market structure. Rallied up to take out market structure right there, and there is no internal structure. It just, and we are bullish because we are going to the upside. So what do you expect price to do? Like I've taught already, scenario 1, we expect price to take out that low. It's going to take out this low and then boom to the upside. How far into this low will it take out is if there is a fair value gap at the left. Now in this case there is no fair value gap, so I would rather just put my buy limit there, right? Very simple. Buy limit there, right? Or I'll wait for a market execution. Once it gets to take this low, I am buying. Now I can actually take some partials right here, right? Take some profits right there, but my overall profits will be at that top side. In fact, maybe for the end of the video, I'll pull that trigger because it's looking to get there. So that's scenario 1. That's scenario 1. Very, very simple to take note of. So let's go back to 15 minutes chart. So you can see I can do this in any time frame. Let's do finally in the 1 hour time frame. Let's see in the 1 hour time frame. This happens in all across all time frame. Look at scenario 1 again. Look at this drop. This is scenario 2 actually. Look at this low. Look at that low that got taken out. Price on its way to take out the low formed a high right there. So it dropped, pulled back, formed the high, and then dropped. So what did we say we expect price to do? We said we expect price to take out that high there. Boom. So what if you had waited for price to come here? You sell off, right? Take your profit. In this case, it didn't get all the way here because of some other things you need to learn, because they were bullish at the time. So this liquidity was what price came to take out, right? Look at that liquidity low, took it out there, and boom, pulled back, and boom. Okay, so there is obviously a little bit of other moving parts you may need to learn or you may want to know. All right, and I'm going to give you a lead on how you are going to learn that. So you have seen scenario 1, you have seen scenario 2. Your task is to go back in your chart in time and start looking out for things like this. This is like your typical scenario 1. Once price broke structure cleanly this way, expect that the high that started that move will be taken out. So you see price took it out, boom. In this case, it didn't return back to bearish, so that does not really fit in perfectly. Look at another example. Drop. Scenario 1, drop. Price had to come back to take that high in that level. Until they took that high, there was no fuel to go on. So honestly, friend, I can go on and on showing you these examples across any pair, all pairs, any time frame, all time frames, weekly, daily, monthly, as the case may be. It happens over and over again. Now, let's get back to our screen and let me wrap this somewhere with something very important for you. All right, so within the past hour, you will agree with me that it's been a time well spent so far. All right, and to think about that this value or knowledge is actually free makes it even more amazing. Now, you can also agree with me that we cannot obviously cover everything, even if I have all day in this webinar. All right, if we have all day, we cannot obviously cover everything. But trust me, the scenario 1 and 2 you have received already is enough to get you funded. All right, but here is something for you to want to think about. Now, I'm going to make you a special offer, right, that will ensure that you get to know every single thing you need to know. All right, and if you act fast, I'm going to make you a very special deal, a very, very special deal. Now, here is a pre-launch as at the time of this recording for, I call it Trading Endgame 2023. I don't know what year, wherever you're watching this, but this applies across all year because this is the market. This is a truism of the market. Now, what you're going to get in this offer is that you're going to learn about the big 6 of trading. There are 6 things. I think we'll handle 3 of them, but there are 6 general things you need to know for you to apply this whole stuff and put them together to make it even very more powerful. You're going to learn structural liquidity in an advanced form. You've learned a couple of them. There are about 4 scenarios. I just gave you 2 in this class. You're going to learn market bias from 3 angles. Bias means the direction the market will go, bullish or bearish. Because once you have understanding of I am bullish or I am bearish, it's going to help you streamline the right liquidity to take and at the right time. Of course, you're also going to learn how to frame your entries. I have 4 A+ setups that I take. 4. I just gave you 2. The other 2, I mentioned one of them during the advert. You are going to love every one of them. Just want to increase or improve your arsenal in this. And then there's a practical session on how you can grow any account. Any account meaning any account size. The problem of traders is not equity. Trust me. You can trade with a $5 account. You can trade with a $10 account. I am not even joking. You can trade with $1,000. If you cannot trade a $10 account, you cannot trade a $1,000 account, right? Because of the knowledge that you're going to have. So practicals on how to grow any account and how to pass a prop firm account. This is my forte, right? I am most confident in prop firm because I believe we are living in beautiful days and you don't need to be thinking of how to have your own $1,000 to trade. You can leverage on a $10,000 account from a prop firm. I made my first million in Naira and in USD from prop firms. Yeah, so we have practical sessions with that. And model 6, which actually like my model 1, is on psychologies and summaries. Now, essentially, all of these things usually goes around between $299 on its own as a course, and we are doing more than just course. All right, but you're not paying $299, so let me take that back. Okay, and of course, you should know if this course is for you. If you're a newbie, we have a session for you. If you've not traded before, there's a session for you. If you have struggled with consistency before now, and you want to scale to the next level, that means you want to now be consistent. Then I think you should jump on this mentorship, right? It's not just a course; it's a mentorship, I should say. And then if you feel you have a point to prove, probably you are ashamed to tell people you are a trader. I was there. You have a point to prove. That means you want to be a winner. Then, by all means, this is for you. Now, I get it. Most of you have bought courses before now, and the whole thing is not adding up. So, I am not selling or presenting course. I am presenting or offering mentorship. Now, I had 2 choices. The first choice I had was to go as cheap as possible and gather in as many persons as possible. And then that would mean having the shenanigans and people who are not serious. And I have done that in time past, trust me. Having trained over 3,000 persons since 2020, I am actually knowledgeable enough to tell you what humans are. Now, the second option, which I feel and know is the best, is to increase the investment fee a bit higher, but in exchange, guarantee your success. Guarantee that you actually get your results. So I am not about courses, nor just community, but about a tailor-made, personalized sort of program with you. You and I in the team working closely. But there is a caveat. You have to qualify for this. All right. Now, here is Mr. Toby, for example. He chatted me up early the year that he grew up. You can see the example in my far left. He traded up a $10,000 account demo to raise it to over $150,000 on demo. Right now, he just started early July. It came up earlier the year, right? And he did that on demo, having learned what you're going to learn much more in mentorship. Now, between that time, that was about February. Between July that year, he bought a prop firm account and he withdrew over 3.7 million naira in naira. And you could see the screenshot and all of those stuff. I think that was around April. And then he sent me this stuff. I mean, it's crazy. Toby is an example, one out of so many other examples of students who are passing prop firms. Like, now when you make your first withdrawal, one thing about trading is that once you make your first withdrawal with logical knowledge, that means you know how you did it. It was not by mistake. Knowing that you can do it over and over and over again. Your first withdrawal is all it's going to take to wipe out the years of hardship and pains trading must have cost you. I'm a living witness. Toby is a living witness. All of our students that have been able to put all of these up, testimonies, testament of these things, and you are going to be our next success story. Just one withdrawal is all it's going to take, and you are never going to remember the times you were indebted, the times you felt like giving up. If you have stayed to this point, then by all means you should hop on in what we are doing. Right now, what you're going to get, again, I have mentioned all of the courses and mentorship. Now, this is the bonus. Number one, you're going to have access to a 1-year in-house practical mentorship where we're going to talk about how to pass your prop firm, how to grow your account practically. All right, there's a WhatsApp group for that. Probably you will see the screenshots of that by the side of this video. And then you're going to have to trade with me. If you have a live account, you're going to be added to our signal room, have access to our signal rooms where you can grow your account for at least 6 months. The goal is not to give you signal to spoon feed you, but to actually ensure you earn while you learn. Right? There's a way that works. So the course, signals, mentorship, right? So now you can be asking yourself, if all this did for you was to ensure that you become profitably consistent, would any amount you pay be worth it? If all this did for you was to ensure you take up a prop firm, a $100,000 prop firm account and pass it, and you start earning between $500 to $10,000 monthly from prop firms, would your investment be worth it? I want you to think about all of this, right? Now, what about becoming your own money multiplier, where you don't need to go out to buy or sell? Like I've been a full-time trader since 2020, the year of COVID, right? I've been trading. I haven't worked for any person since then. Take care of my family, and I'm expecting a child as at the time of recording, and life gets beautiful. I mean, there is a lot of money to be made in trading. I don't need to tell you lots of stories. So if all this did for you was to ensure you become your own money multiplier, would the investment you are going to put into this be worth it? Seeing that you're not just going to have a course, you're going to be working with me on a close and personal basis. Would that investment be worth it? Can you push yourself for a leap of faith for the last time? If there is a word like that. So here's a question for you. What's financial freedom worth to you? So if you are given a pack called financial freedom, how much are you willing to pay to get that pack called financial freedom? In fact, to you, what is financial freedom? Is it $1,000, $5,000, or when you have $1 million in your account? So what are you willing to pay for it? Well, feed that in your mind, because we are all different with respect to what this would mean. Now, in the past, Mentorship and programs like this in our academy cost anywhere between $749 to $999, because I will be not just giving you material but coaching you through the process. Every morning between the 5 days of the week, you have something to consider for the day. In the evenings, we do market overview. Within 3 months, usually you should be good, right? So now the price range differs. Now here's what I now did. I broke down our offer into 3 plans based on your budget and what you want. All fingers are not equal. If you are going to be just in the community, learn fully every single thing I have mentioned, there is a plan for you. If your budget would fit in for just a course in the community alone, there's a plan for you. If your budget will fit in for one-on-one with me, apart from community, you're still going to have a session with me one-on-one, there is a plan for you. So whenever you don't have an excuse, that's the point. You shouldn't have an excuse. So there's a budget-based mentorship system that I'm offering right now. All right. And so what you want to do to see which of them would work for you, there is a link below this video. All right. Click the link. You'll be met or greeted with a page where I will explain what the 3 tiers and what you are getting would entails. So all you need to do, click the link, fill the form, let me know what you expect, let me know what your budget is. Myself or any member of the team will call you, and if you are qualified, we're only going to call you if you are qualified, right? So click the link, fill the form, schedule a call, ensure you book a call. Ensure you book a call with our Calendly. We're going to call you either via phone call directly or via WhatsApp, wherever you're streaming from, and then we will discuss going forward. And here is another plan. You have the option of splitting payment. All right. So the investment, you can do it once, twice, or thrice maximum. So again, if this interests you, click the link or type this link in your browser, golfcoursefs.club/enroll. Go into the program, fill in the form ASAP, and we will call you. Please note that we have a threshold, right? And here is a bonus for those of you, because the moment you signed up for this class, we have your email for the next 3 days. So if you watch this training up to this point, you have about 72 hours to act. And if you are acting before 72 hours or on before 72 hours, you are going to be having this bonus from me to you, right? And that is, you're going to be having my exact prop firm trading template. The templates I used in passing several hundreds of thousands in USD from my Forest Fund and Funded Nest. The same template, so you can follow sequentially if prop firm is your thing, and you should start considering prop firms, right? So, and to get started again, click the link below this video or type the link right here. You can see and schedule a call. All right. Now you have 2 choices. The first is to close this video and do nothing with it, and that's absolutely 100% risk free. But I don't believe you have stayed over an hour 30 minutes up to this point to just go like that. That is your first choice, and it's risk free. The bad side is that you are going to apply what you have been taught. You will see success, but it will take you lots of months of trial by error. You want to be guided, right? So, but the risk free, which most people will take, is do nothing. The second idea or option you have is to rack up the investment. Before the investment, book a call, book your slot, discuss with us, let's see how best to help you, and then give this a shot. And if it doesn't work well, I am confident this will work well. You have a 100% money back guarantee, right? Money back guarantee. Okay, so click the link below the video or type the link you can see on the screen and book a call. Again, what you are having access to, the course, the mentorship. All right, and I'm going to give you my best-selling book, the One Trade Pattern ATM Machine Blueprint. That's if you're booking a call within 24 hours, you're already on board there. You're going to have access to this material as well. I mean, it's a book that explains what you're learning, but this time in another dimension or another perspective. You're going to love it, only for those who are coming in within the next 24 hours. So get started on your budget-based mentorship program by clicking the link below, schedule a call with me or any of my team, and I will see you on the other side. Honestly, if you ask me, it's a no-brainer. what you're going to find that in the other page. No brainer. Just fill in what you're comfortable with, and we will take it up from there. Other than that, thank you so much for staying through to this time. Jay Okoli is signing out, and I will talk to you much more on other platforms. Cheers.